Most people believe financial crises begin with a moment of chaos, a market crash, a bank collapse, a sudden wave of panic. History seems to confirm it. We remember the headlines, the fear, the collapse, the shock. But the real story is very different, because crises don't begin with noise. They begin in silence. No alarms, no warnings, just small, quiet shifts buried deep inside the system. A change in incentives, a buildup of hidden risk, decisions that seem harmless, even smart at the time. And while everything looks stable on the surface, something deeper is already breaking. By the time panic finally reaches the headlines, by the time markets fall and people react, the real damage has already been done. What we call a crisis is often just a final scene, the visible ending of a story that started years earlier. So what if we've been looking at financial crises the wrong way? What if the crash isn't the beginning, but the consequence? To understand why, we need to go back long before the panic ever begins. We often remember financial crises by their breaking point, the day markets collapse, banks fail, fear spreads across the world in a matter of hours. These are the moments that stay with us. The images, the headlines, the sense that everything changed overnight. But those moments are only the surface. What we see is the climax, not the cause. Because long before the collapse, something else is already in motion. Something slower, something harder to notice. A chain of events begins to form beneath the surface. Credit expands. Risk quietly increases. Confidence grows, often without reason. And with each step, the system becomes more fragile. But here's the problem. None of this feels dangerous at the time. In fact, it often feels like progress. Growth looks strong. Markets look stable. People feel secure. That's why crises feel sudden. Not because they appear out of nowhere, but because the warning signs are hidden in plain sight. To understand this, we need to look beyond the crash itself. We need to follow the invisible chain, step by step, because only then can we see how a system that looks stable can already be on the edge of collapse. And that leads us to the real question. What exactly is building beneath the surface? If we look back at history, a clear pattern begins to emerge. Not chaos, but repetition. Periods of rapid growth, rising confidence. A belief that the system has finally become stable. Again and again, it feels the same. In early banking systems, trust expanded faster than safeguards. Banks issued more claims than they could support. But as long as people believed in the system, it held together. In modern financial markets, the pattern didn't disappear. It evolved. New tools, new institutions, more complex systems built on the same foundation, confidence. And each time, the story followed a familiar path. A boom begins. Opportunities grow. Risk-taking increases, slowly at first, then all at once. But here's what makes it dangerous. The warning signs are always there. Rising debt, overvalued assets, fragile structures hidden beneath strong appearances. Yet they are rarely recognized for what they are. Because during a boom, success feels like proof. High prices feel justified. Growth feels permanent. And the longer it lasts, the more normal it seems. That's why every era believes it is different. That this time, the system is stronger, smarter, safer. But history tells a different story. The deeper we look into the past, the clearer it becomes. Crises are not random events. They are built step by step, not accidents, but processes already in motion. And once that process begins, the next stage becomes almost inevitable. At the heart of every financial crisis lies a simple idea, an idea that feels comforting but is deeply dangerous. The belief that risk has disappeared. It doesn't happen all at once. It builds slowly. As the system grows, confidence grows with it. Past success starts to feel like proof of future safety. People begin to trust the system, not just cautiously, but completely, and that's where the shift begins. Safeguards that once seemed essential start to feel unnecessary. Rules are relaxed. Standards are lowered. Warnings are ignored. Not because people are careless, but because nothing seems to go wrong. At the same time, the system becomes more complex. New financial instruments appear. Layers are added. Connections multiply. And with that complexity comes a hidden danger. Fragility becomes harder to see. What once was simple and transparent is now opaque and difficult to understand. Risk doesn't disappear. It moves. It spreads across the system, hidden behind structure and scale. On the surface, everything looks stable. Markets are calm. Growth continues. Volatility seems low. But underneath, the system is being stretched. Balance sheets become tighter. Dependencies grow stronger. Margins for error shrink. And the most dangerous part? The system begins to depend on its own stability. It only works as long as nothing goes wrong, which means even a small disruption, a missed payment, a drop in confidence, a single unexpected shock can trigger something much larger, because what looks like stability is often just pressure waiting to be released. And once that pressure finds a way out, the process moves to its next stage. The real turning point comes when we change how we see crises, not as sudden shocks, but as slow accumulations. Because nothing in a financial system happens in isolation. Every decision connects. Every action leaves a trace. A bank takes on slightly more risk. An investor reaches for higher returns. A regulator looks the other way, just this once. Each step seems small, reasonable, even necessary. But over time, these steps begin to layer on top of each other. Incentives start to shift. Short-term gains become the priority. Long-term risks fade into the background, and the system adapts to this new behavior. More credit is created. More leverage is used. More assumptions are made about stability. At first, this feels like strength. Growth accelerates. Profits increase. Confidence deepens. But underneath, something else is happening. These layers are not reinforcing the system. They are quietly weakening it. Because each new layer adds complexity. Each new connection increases dependency. Each new risk becomes harder to detect. And the system becomes less resilient. Not because of one bad decision, but because of many small ones built over time. That's the insight. A crisis is not triggered by a single event. It is the result of accumulated pressure. And once enough pressure builds, the system no longer needs a major shock. Even a small disturbance can bring everything down. Consider a moment when everything seemed stable. Growth was strong. Confidence was high. The system looked solid from every angle. In the years before the 2008 financial crisis, this is exactly how the world felt. Housing prices kept rising. Credit was easy to access. Banks were expanding. Investors were optimistic. And risk appeared to be under control. On the surface, it looked like progress, a stronger economy, a smarter financial system. But beneath that surface, the same pattern was quietly unfolding. Loans were being issued to borrowers with weak ability to repay. Complex financial products were built on top of those loans. Risk was packaged, reshaped, and spread across the system. And with each step, the structure became more fragile. But almost no one reacted because the signals were easy to ignore. Default rates were still low. Prices were still rising. Confidence was still intact. The system looked stable, so it was assumed to be safe. Then came the turning point. A small rise in defaults. A slight shift in confidence. Just enough to expose what had been building underneath. And suddenly, everything changed. Markets froze. Institutions failed. Panic spread across the global system. To many, it felt like a sudden collapse. But in reality, it wasn't sudden at all. It was a result of years of accumulation, layers of risk, built quietly over time. The crisis didn't begin when the system broke. It began long before, when the system first started to stretch beyond its limits. As financial systems grow, they don't just become bigger. They become more connected. Banks link to other banks. Markets link across countries. Institutions depend on each other in ways that didn't exist before. What was once local becomes global. In earlier systems, a failure could be contained. A single bank collapse might cause damage, but the impact had limits. Now, those limits are harder to define. A problem in one corner of the system can quickly spread to another. and then another, like a chain reaction. This is the hidden effect of expansion. Complexity increases, connections multiply, and with them, the pathways for risk. But here's the paradox. It feels safer, because risk is no longer concentrated in one place. It is distributed across many institutions, many markets, many countries, and that creates an illusion of stability. If one part fails, others should absorb the shock. At least that's the idea. But in reality, the opposite can happen, because when everything is connected, everything is exposed. A single disruption can travel faster than ever before, crossing borders, crossing markets, amplifying as it moves. And risk doesn't disappear in this system. It becomes harder to track, harder to measure, harder to control, which means by the time it is finally seen, it is already everywhere. And that raises a deeper question. If risk is so hard to detect, how do we even recognize in the modern world? Today's financial world moves faster than ever. Transactions happen in milliseconds. Money flows across borders with a single click. The system is more digital, more advanced, more interconnected than anything in the past. And because of that, it feels more secure. Data is everywhere. Models are more sophisticated. Risk appears to be measured, tracked, and controlled. But the pattern hasn't changed. Confidence still rises during periods of stability. Risk still builds beneath the surface. And recognition still comes too late. Only now, it happens at a different scale. Leverage can grow faster. Markets can react instantly. And shocks can spread across the world in seconds. What once took years to unfold can now develop in a fraction of the time. But the core dynamic remains the same. Periods of calm create trust. Trust encourages risk-taking. And risk, when layered over time, creates fragility. The difference is not the system. It's the speed, which makes the warning signs even harder to see. Because everything looks stable until it doesn't. So the question is no longer whether these dynamics still exist. They do. The real question is, where are they forming right now? And more importantly, would we even recognize them if they were? What makes financial crises so deceptive is not their complexity. It's their timing. Because the most dangerous phase doesn't look dangerous at all. It looks stable, predictable, even perfect. Markets are calm. Growth is steady. Losses seem rare, almost irrelevant. And that creates a powerful illusion. If nothing is going wrong, then nothing can go wrong. But this is exactly where the risk hides. Because stability changes behavior. Investors take bigger positions. Banks extend more credit. Systems are pushed closer to their limits. Quietly, gradually, and with each step, the margin for error disappears. But no one feels it. There is no panic, no warning signal strong enough to break the confidence. Only a system that appears to be working exactly as intended. That's the deception. The closer everything moves toward perfection, the closer it often moves toward failure. Because perfection in a financial system usually means it has stopped preparing for stress. It has adapted to calm and forgotten how to survive disruption. So when the shock finally arrives, it doesn't meet a strong system. It meets one that has quietly become fragile. And by then, it's already too late to fix it. In the end, financial crises don't begin with panic. They end with it. The fear, the headlines, these are not the start of the story. They're the final chapter. Because long before the collapse, the real process is already unfolding. Years of small changes. Silent risks building beneath the surface. Confidence growing stronger and less questioned. Nothing feels wrong. In fact, everything feels right. And that's what makes it dangerous. Because when risk is invisible, it is allowed to grow unchecked. When confidence goes unchallenged, it turns into assumption. And when systems appear stable, they often stop preparing for failure. That is where crises are born, not in chaos, but in calm. Once you begin to see this pattern, every sudden collapse starts to look different, not as an unexpected disaster, but as a predictable outcome, the result of a process that was always there, just hidden in plain sight. And the next time stability feels certain, it may be worth asking, what's building beneath it? If this changed the way you see financial crises, then you're already looking deeper than most. Because beneath every stable system, there are patterns waiting to be uncovered. And the more you understand them, the clearer the future becomes. So, if you want to see what others miss, make sure to subscribe and stay with us. Because the next crisis may already be in motion, long before anyone notices.